We're all familiar with the global concerns influencing investors right now. The big one in the UK is probably Brexit. Tom, in the UK, the Brexit question seems to be, should we stay, should we go? Is that the right question?
Gary, you're absolutely right. It is the wrong question because we can never really leave the EU. As long as we still want to trade with it, we will have to conform to their weights and measures system, their product descriptions. And so the idea that we can leave in splendid isolation in the full sense of the word and say produce semi-skimmed milk with whatever fat content we like and still call it semi-skimmed milk, as an example, is completely false. Equally, the idea that by remaining we're going full feet into a European superstate as it goes on its voyage of discovery is false. We will continue to be the Eurosceptic little island in the Atlantic that doesn't enter wholeheartedly, that gets opt-outs as we currently have.
So if we've got the wrong question, what about the right argument? The Vote Leave campaigners would have you concentrate purely on immigration and sovereignty, the more emotive issues, and they're ignoring the economic argument. Is that the wrong argument?
Well, they're ignoring the economic argument because they feel they've lost. There are lots of studies, a multitude of studies that we'll all be familiar with, whether from the IMF or OECD, that point to a shrinkage in the economy over the few years after Brexit, as the sheer disruption has an impact and foreign investment dries up as we lose that instant market access that we currently have to the EU. And so there's a definable hit to the economy that even the most enthusiastic Brexiteers no longer seriously deny. So they're now moving on to other issues, particularly immigration and sovereignty. But the problem for them, as this first chart shows, Gary, is that if you try and limit mass EU migration, it will come as an economic cost, because one of the reasons why we've had low inflationary growth in the UK over the last 15, 20 years is that pool of skilled and unskilled labour that's come into the UK as market forces have dictated, not as some points policy has dictated, as the Brexiters would like to have, that's helped fuel the growth of new industries, such as corner coffee shops, that are able to take on skilled labour from the continent and produce coffees for us to drink without price inflation coming through higher wages, as they'd have to scamper around looking for UK skilled workers to work in them if we exited ourselves from the free labour market. When it comes to sovereignty, well, this chart here shows very clearly that the more sovereignty you want, say in avoiding Brussels red tape over product regulation, the less you conform to the existing models of Norway or Switzerland as a member of the European Economic Area or EFTA, respectively. The more you go your own way in freeing yourself of red tape, the more you will find yourself going towards WTO relations with the EU that make it much more expensive trade.
The question I would want to ask is, so what? What should investors be considering in terms of the asset classes they invest in should the UK leave the EU?
They have a lot to worry about, because I think we will see turmoil in financial markets. And the best thing to do to protect yourselves against that would be a multi-asset active investment portfolio with a firm hand on risk. You do not want to go for return while ignoring the risk elements. And the first financial asset that would come to the attention of investors would be sterling. We've already seen that being extremely sensitive to movements in support for pro and leave the EU. And Goldman Sachs estimate that that could fall by 20% against the dollar if we left, all of which would happen fairly quickly. Now, this would then come through probably into a rise in inflation through imported inflation, which would cause problems on the bond market, particularly, I'd say, with UK domestic-focused corporate bonds. But gilts would also be affected because, of course, with a new government coming in, that would be more populist. You'd not only have inflation for investors to contend with, but you'd have probably an end to austerity, because a new government will be nothing if not populist. And I'd also add, within stock market investments, I think mid and small cap stocks would underperform blue chips, because blue chips would have the benefit of export earnings that would be in higher value in sterling if sterling falls, whereas mid and small caps don't have that support.
While all this is going on and asset classes reacting to Brexit, what's the reaction going to be from the Bank of England?
Oh, they'll be sitting on their hands. Not because they're too lazy, but because they are terrified that if they raise interest rates to defend the economy against inflation and a potential currency crisis, because bear in mind we're running a post-war record current account deficit, but they fear that if they raise rates in that environment, they'll destroy growth and will fall into stagflation. So I think they'll wait 6 months or so. But that doesn't mean that, say, the mortgage market is free and that the housing market won't be affected, because, of course, commercial mortgages are priced off the gilt yield curve. And if that rises, then you can see, say, buy-to-let investors taking horror at much more expensive rates if they roll over their fixed interest buy-to-let mortgage. And so I do think that the housing market, particularly in London, is vulnerable, even if the Bank of England sits on its hands and does nothing.
So we've got a 6-month outlook for the Bank of England. We've got, by the rules of the referendum, at least 2 years for the government to react. What is the longer term political picture going to be?
Well, the Brexit campaigners will say, hey, with a reduced value of sterling against other currencies, we'll trigger an economic renaissance through exports. But who would we be exporting to? Bearing in mind our relations with chaos, our relations with EU clients are in chaos for at least 2 years while we work out new trading arrangements. Obama has shown that he's in no hurry to do a rapid trade deal with the UK to boost our exports to the US. So I think over the near term anyway, over the next couple of years, I do fear weak growth. So continued low interest rates from the Bank of England, although that is dependent on just how severe the current account deficit weighs on investors' mind. And clearly the Bank of England won't want to let sterling fall too far, otherwise it would have a huge impact on the price of imports of raw materials for our industry. So longer term, politics is very interesting, because I do think that a more populist government will be more right-wing in its tone, and that will extend through to the European Union as well. A Brexit that is successful would give hope to far-right parties throughout Europe and far-left parties that want their country taken outside of the EU. So I think European politics would become far more polarised and unhappy.